Hi, I'm David Traversi, and this is part of our series called How to Sell Your Business. The overwhelming valuation standard for private companies is a multiple of annual cash flow. In this episode, we're just going to address annual cash flow. In the next episode, we'll talk about the multiple that you apply to that cash flow. The most common definition of cash flow in M&A transactions is EBITDA, which is earnings before interest, taxes, depreciation, and amortization. The calculation of EBITDA is produced through a standard accounting exercise familiar to all accountants and most controllers and bookkeepers. The EBITDA that is used in valuations is generally what was produced in the prior fiscal year, but variations include trailing 12 months, which produces a higher EBITDA for companies growing in profitability, and current year, which therefore includes projections for the remainder of the current year and produces, for companies growing in profitability, a higher EBITDA. In our case study with Patsy, if the appropriate, and we'll discuss appropriate below, if the appropriate EBITDA multiple for Patsy's business were 6 times the most recent year, her business would be worth $6 million. In other words, 6 times EBITDA of $1 million equals $6 million. After paying off debt of $1 million and assuming no other adjustments, Patsy would receive $5 million in the sale. If the appropriate multiple were 6 times applied to her projected current year EBITDA of $1.2 million, her business would be worth $7.2 million, and she would receive $6.2 million in the sale after paying off $1 million in debt. If the appropriate multiple were 6 times applied to next year's projected EBITDA of $1.44 million, she would receive $7.64 million in the sale. In other words, 6 times the EBITDA of $1.44 million less the $1 million in debt. Now, let's talk about EBITDA adjustments. The complications in calculating the appropriate EBITDA arise where something abnormal or extraordinary occurred that pushed the EBITDA lower or higher from what it would be under normal circumstances. The following are examples of common extraordinary items affecting EBITDA. 1. Owner compensation. Under or over market compensation paid to the business owners. In our case study, Patsy might pay herself $500,000 annually, where the market rate for an executive like her is $200,000. Patsy will want to add the amount paid over market, or $300,000, back to her EBITDA. 2. Extraordinary expenses. For example, uninsured repairs for damage resulting from a 100-year flood or a complete branding overhaul that would not occur under normal circumstances. The seller will want to reduce their expenses, thereby increasing EBITDA by those amounts. 3. Owner expenses. Expenses arguably relating to the owner's personal life that would not ordinarily be a business expense. Again, the seller will want to reduce their expenses, thereby increasing EBITDA by those amounts. 4th, extraordinary income. For example, a disaster relief grant or payment of a large old account receivable that had been written off years ago that would not occur under normal circumstances. The buyer will want to reduce EBITDA by those amounts. EBITDA adjustments usually become fodder for negotiation between you and the buyer. You argue that several expenses were extraordinary and should not be expected by the buyer under ordinary circumstances, and you therefore adjust your EBITDA upward. The buyer argues that such expenses are quite ordinary in nature and therefore is quite happy with the lower unadjusted EBITDA. In calculating a normalized or adjusted EBITDA as a seller, we recommend calculating a worst-case scenario, in other words, no expense reductions and all possible revenue reductions, a best-case scenario, all arguable expense reductions and no revenue reductions, and what you expect would be a reasonable negotiated compromise of items in each of the other scenarios. As with all negotiations, your first position will be the best-case scenario, but you'll be prepared for that to be adjusted downward through negotiation. In the next episode, we'll address the EBITDA multiple. Thank you, and look for future episodes of How to Sell Your Business.